$30,000. Brown is 18 years old. He has no full-time job, no meaningful credit history, and almost no savings. Brown asks a lender for $30,000 to buy a car. The lender asks for his income. Brown does not have one. It asks for his credit history. Brown's credit file is less of a file and more of an empty folder. It asks for a down payment. Brown has almost nothing. The answer is denied. Brown then asks for money to start a business. The bank wants revenue, cash flow, collateral. Brown has an idea and a notebook. Again, denied. Then Brown applies to college. He completes the FAFSA. His school sends him a financial aid offer. And over the course of his undergraduate education, Brown may become eligible for close to $30,000 in federal student loans. For most federal student loans, no established credit history is required. No full-time job is required. And no cosigner is required. Same Brown. Same empty credit file. Same uncertain future. So why is borrowing $30,000 for a car or business so difficult? While borrowing almost $30,000 for college can be built directly into the enrollment process? And what exactly did anyone check before offering Brown the money? Let us rewind. Brown wants to attend college because he believes education can lead to better work. That belief is not imaginary. On average, workers with bachelor's degrees earn more and face lower unemployment than workers whose education ended with high school. But an average describes millions of people. Brown must repay his loan as one person. His specific school matters. His specific program matters. Whether he finishes matters. And the job he eventually finds matters. Brown has another problem. The college needs to be paid now. But the income that may justify its price might not arrive for several years. Current Brown needs money at 18. Future Brown may earn more at 22. The student loan connects them. Current Brown receives the education. Future Brown receives the responsibility to pay for it. Without that bridge, many students without wealthy families or established credit could not attend college. But access and affordability are not the same thing. Brown first sees this difference inside his financial aid offer. The document contains several categories. Grants and scholarships. Money Brown generally keeps. Work-study. Money Brown must work to earn. And loans. Money Brown must repay. All three may appear under the heading financial aid. But only one sends a bill to future Brown. After Brown accepts the offer, he looks at his school account. Tuition, covered. Housing, covered. Amount currently due, $0. The price did not disappear. It changed addresses. It left the college billing page and moved into Brown's future. Brown does not receive one $30,000 check. Federal undergraduate loans have annual and total limits. For a dependent undergraduate, the combined limit can begin at $5,500 in the first year and reach as high as $31,000 across undergraduate study, depending on eligibility and circumstances. That prevents Brown from borrowing an unlimited amount at once. But it also divides one large commitment into several smaller decisions. First year, accept. Second year, accept. Third year, accept. Each decision solves the problem directly in front of him. Another semester is paid. Another year can begin. The total commitment remains somewhere in the future. But here is the part Brown misunderstands. Brown was not approved in the same way a bank approves a car loan. He met the federal program's eligibility requirements. And his school certified the amount he could receive. That process checked several things. Was Brown eligible for federal student aid? Was he enrolled at an eligible school? Did the amount remain within the applicable loan limits? How much did the school say attendance would cost? Those questions were checked. But several other questions were not answered. Would Brown complete the degree? Would employers value his specific program? Would a suitable job exist when he graduated? How much would Brown personally earn? And would that income make the debt comfortable to repay? The loan process determined whether Brown was allowed to borrow. It did not determine whether his education was a good investment. That distinction explains the entire system. A traditional lender looks at Brown's existing income, assets, and repayment history. An 18-year-old usually has very little to show. If education loans followed exactly the same process, many young people who needed financial assistance most would have the lowest chance of qualifying. Federal student loans replace some of that traditional underwriting with eligibility rules, borrowing limits, and borrower protections. This makes education accessible to more people. But it does not remove the uncertainty. It transfers much of that uncertainty to Brown. The school receives payment for the education it provides now. The government receives Brown's legal promise to repay. Brown receives the opportunity to earn a credential and potentially raise his future income. But an opportunity is not a guaranteed return. A car has a market value. If Brown stops paying, a lender can repossess it and sell it. A house can also serve as collateral. Education is different. Nobody can remove 3 semesters of accounting from Brown's memory and sell them to another student. A degree has no guaranteed resale price. Its financial value depends on what Brown studies, where he studies, whether he finishes, and what happens in the labor market afterward. That means the same loan can create completely different results. One Brown completes his program, enters a stable career, and earns enough to justify the debt. For him, the loan works as intended. A second Brown graduates but earns far less than expected. He receives the degree, but not the financial return he imagined. A third Brown leaves before completing the program. He keeps the debt, but never receives the credential that was supposed to help repay it. Same eligibility rules. Similar amounts borrowed. 3 completely different outcomes. Yet the offer can create the same feeling for all 3. Approved. Approval feels like reassurance. Brown assumes that if the money was offered, someone must have decided the education was worth financing. But the amount offered is a ceiling. It is not a recommendation. Eligible for $5,500 does not mean you should borrow $5,500. The financial aid system tells Brown what resources are available. It cannot decide whether this particular school, at this particular price, is the right investment for his future. Brown must investigate that separately. So before clicking accept again, Brown opens the college scorecard. He looks beyond the college brochure. He checks the school's actual cost, its graduation rate, the typical debt carried by borrowers, and the earnings reported for graduates of the program he is considering. The data cannot predict Brown's life, but they can replace a vague promise with a more realistic range of outcomes. Brown now asks 3 questions. First, how much will the entire program cost to finish? Not the amount due this semester. The likely cost of every year required to earn the credential. Second, what happened to students who entered this school and program? How many finished? How much did borrowers owe? And what did graduates actually earn? Third, what happens if Brown does not finish? Can the credits transfer? Is there a cheaper route into the same career? And how much debt would remain without the completed degree? The bank rejected Brown's car loan because it could not see enough income, credit, or savings today. The student loan was different. It was built around the possibility that education would help create income tomorrow. Sometimes that possibility becomes real. Sometimes the degree produces far more value than it costs. But the offer never promised Brown that the program was worth its price. It only allowed him to pay that price with money he had not earned yet. A student loan tells Brown how much he is allowed to borrow. It does not tell him how much he should borrow.